Let's begin. Hi, everyone. I'm Rick Bensignor. Today is Tuesday, August 30th. Welcome to this week's In the Know Trader Show. Looking at our agenda for this webinar, in our trader education portion, I'm going to title this, 2 is better than 1, but 3 or more is best. We'll see what I'm talking about. And then in our sector focus, this week, we're going to look at the S&P Industrial sector through the Xli Etf. We'll take a look at that chart. Then we'll take a look at XLI versus the S&P to look at its relative performance, and then dig into the top 10 holdings in the Xli ETF, starting off with UPS. What do we have for products for you from In the Know Trader? Well, we've got a weekly tactical trader report that focuses on ETFs, but in that report, you get a wide span of the macro universe of what's going on across the bond market, the stock market, with a deep dive into the S&Ps, the US dollar, usually gold, oil. Sometimes we look at credit markets. Whatever you need to know about for the coming week, we focus on with a deep dive into them. Then we get into a new ETF recommendation each week. Generally, I'm looking for a tactical trade somewhere between holding a few weeks to a couple months. So it's not long-term investing. At the same time, it's also not very quick in and out. So if you like day trading, this report comes out once a week. That's not for you. These are short-term tactical trades, again, in the couple weeks to few months type holding period. That comes out Thursday nights. Then once a month, and today's Tuesday, tomorrow's the last day of August. So tomorrow night, a new issue of the 7-Eleven report comes out. It'll be the September issue. In this report, what we do is pick no more than 7 of the 11 macro spider ETFs to be invested in for the month, with the goal of outperforming the S&P by trying to avoid being heavily invested or invested at all in the underperforming sectors. So 4 sectors of the market we will not be partaking in each month. And to show you how well we've done, going through July 31st, and we'll have new updates tomorrow night, but through July 31st, we are outperforming the S&P by 2.6% this year. We've outperformed 6 of 7 months. In the 2 years since we started this on August 1st of 2020, we are outperforming the S&P by 7.16%. That is incredibly productive and puts me at the very high end of those who benchmark to the S&P and their performance. And of course, we are directly investing in the sectors that make up the S&P. So we don't get down to individual names. There are 11 sectors to the S&P. We choose no more than 7 of the sectors, for example. The sectors include energy, financials, utilities, industrials, technology, REITs, healthcare, staples, utilities, communication services, materials. I think I probably hit all of them. 4 of those, and sometimes 5 of those, will not be included. So you get the exposure to the market, but hopefully you don't get exposure to those that underperform. If you can avoid the underperformers, mathematically, you will outperform. And that is the goal here. And if you think it's easy, it's not, because 6 out of 7 money managers historically do not outperform the market. Very few do. And to be up over 7% in 2 years relative to the S&P, this is not a hedge fund. This is simply being in the sectors of the market and picking the ones to essentially not be in is the game. And it's really the same game that every mutual fund manager who's benchmarked to the S&P is doing. They just get down to the stock level. We're doing it through ETFs of the sectors. So we'd be in the top 10% of all people who do this. So if you're a financial advisor and you have clients in the market who are in passive indexes like spiders, you are far better off, or at least historically have been far better off being in and following the 7-Eleven recommendations. If you're an individual investor who has money in spiders, we can outperform and have outperformed. So certainly consider subscribing to it. We have a free 7-day trial for anybody who signs up to the Tactical Trader Report or the 7-Eleven monthly report. And we have a greatly reduced price when you sign up for both. So go to inthenotrader.com in order to sign up for those. If you're watching this, you're probably watching it on my YouTube channel. I started this recently, just a couple months ago. There's a link here we're showing you in order to follow the channel. So here is a shortened link to the much lengthier string that you would have. But you certainly can go to YouTube, put in the No Trader channel, and sign up for my channel. So look, I am no longer affiliated with stock charts. I'm not doing my weekly videos through them any longer. I produce these myself, and we do these all through In the Know Trader. So sign up on YouTube to follow. And once you follow the channel, you will get a mail notification every time I put up a new video. And my Twitter handle is @InTheKnowTrader. So you can follow me on Twitter too. And I don't use that as frequently, but I still put out stuff on Twitter. So all different places that you can, subscribe to our reports, follow my videos on YouTube, and follow me on Twitter. Okay, let's talk about this idea of 2 is better than 1, but 3 or more is best. And what I'm talking about here is lining up technical indicators that show up in the same area such that you could buy a stock that pulls down to, let's say, an uptrend line. And you've got a reason that you can be a buyer where you are. Let's say it's the uptrend line. So that's one reason that you could buy that name. And it may work, but let's say at the same place you had that uptrend line, you also had a moving average or a prior low that was a significant low that is virtually at the same level. Well, now you have 2 reasons, unaffiliated, right? A trend line and a prior low are not going to come in. If the uptrend line has slope to it, if you sell down to the uptrend line, some important prior low is unrelated to the fact that that happens to be where the value of the trend line is at any given day or week. So now you have 2 reasons you could be a buyer. And I'll argue the case that having 2 unrelated technical reasons to buy at a particular level, or same thing for selling, gives you more evidence that that level certainly could hold and that you could get a bounce off of that. So it's a better reason to potentially put that idea on as compared to simply having one and only one reason to do it. Let's say that where your uptrend line is and a prior low is, you also have, let's say, a moving average fall into an important moving average that you look at falls into that same level. So as I put this together now, let's say a 50-day moving average happens to align to where, very close to where a trend line is, which happens to be where some important prior low was. Now I have 3 reasons that all within this little area, one could potentially get a trading bounce, and or even more significant than the trading bounce. But in other words, the support is stronger the more different indicators we have that can line up in the same general area. And sometimes they get super close to each other such that you really have a very small zone where you have multiple indicators show up. So while that's all happening, as I described, let's say your RSI chart is oversold in an uptrend. And if you get oversold in an uptrend, that's often a pretty good time to consider being a buyer. So now you have 4 reasons that potentially tell you to be a buyer. And let's say that the sell-off was done such that you now also have potentially you're forming a candle pattern that's bullish, whether let's call it a hammer bottom, maybe a bullish engulfing pattern, something that would suggest a bullish move. So here's an example that I've just put together that has 5 unrelated technical indicators that are all pointing to a small zone where you have the confluence of all of these happening at the same time. You have a much better chance that this is going to work. It doesn't guarantee it will, but 2 things happen. One, having multiple indicators show up at the same place means that you have more potential buyers showing up because some may be looking at part of these, but not as many as you might be. So you have other buyers joining in, which should help absorb the selling pressure to potentially bounce. And secondly, and just as importantly, it gives you more confidence, and your ability to stick with the trading idea is stronger than if it was simply the trend line. Because if the trend line broke, you may say, oh, I need to get out. But if just beneath the trend line, you also have a moving average, well, now let's say the moving average would also need to break in order for you to get out. And the candle pattern would have to now nullify the bullishness in order for it to, disappear and maybe become bearish. In other words, the more things you have that line up together and have when you get a confluence of signals in the same approximate area, the more confident you can walk into your trade as being that this is likely going to at least hold the first time down, and that you should get some bounce off of it. And depending upon if this is a short-term trade for you, more of an investment idea, will determine how long you might want to hold on to it. And it's important to kind of know that as you go into the trade, if you're looking to trade it as compared to buy for an investment. And that changes your potential, not only holding period, but also how much you're willing for this to go against you. If you were looking to buy stock XYZ at $50 a share for a long-term investment, you might be okay with it going to 45 because you think it's going to 100 in a couple of years. Well, if you can double your money and only risk 10%, it's not a bad thing. If you're a trader and you're looking for the $50 level to hold, but you're only looking for it to go to 53 or 54, well, then you're certainly not going to risk down to 45. You're risking more than you're looking to make. So you need a much tighter stop in order to have your risk and reward line up properly. So I just want to conclude in this by saying that the more indicators you can get that are unrelated indicators. So for instance, if you say, well, the RSI is oversold and so is stochastics, so now I have 2 reasons to buy stock XYZ, I'm going to tell you that RSI and stochastics are virtually the same type calculation, and are going to show up in your charts very similarly as being overbought or oversold at the same time. So that's not 2 unrelated indicators. But let's say a moving average to an oversold RSI with a positive candle that is holding against a prior low where you find a trend line, and now I have 5 different reasons. Any one of them I could use, but 5 together in a very small area on the chart, I'm going to have more confidence that this should work, and I'll just walk into the trade with more confidence. And that confidence is not meant to be cocky or like, oh, I got this perfectly, because it still may not work. But my guess is after doing this for 40 plus years, A, you're going to feel more confident walking in, and B, there's actually a better chance your trade will work. So remind yourself that when you're looking for a trade idea and you look to buy something or sell something because an indicator shows up, oh, we hit an old high. Well, yeah, you could lean against an old high to sell against, but that old high may hold or not. And if the market trades above that old high, how much are you willing to let it go before you, let's say, cover a short or get back into a stock that you've just sold out of? As compared to that old high is where a downtrend line is, where some bearish candle pattern is, where the top of the cloud is, and a variety of indicators that are all unrelated to each other, the better the chances that the trade is going to work. So that's today's trader education portion. Let's take a look at the industrial sector. So what I want to do here is let's take a look. Here's the 10 biggest names in the S&P Industrial sector. So it starts off with UPS at 5.25%, and Union Pacific right beneath it at 5.2%, and Raytheon at 5%. So notice the first three stocks only represent 15%, 15.5% of this index. And as you go down to look at the top 10, you see that Honeywell is 4.8, Caterpillar is 3.9. And so this is not a S&P index that is, let's say, similar to communication services, XLC, which the top two names being Meta, the old Facebook, and Google, and of course there's two Google stocks, so those combined equal well over 40%. Those two company names represent over 40% of that ETF. So you really need to know what those two stocks are doing and have an opinion on those two stocks if you're going to go into XLC. If you go into XLY, you've got, which is consumer discretionary, you have Amazon and Tesla as the two biggest names. And combined, they're not as big as what those two names represent in XLC. But if you're going to play XLY, you kind of have to have your opinion on what Amazon and Tesla are going to do because they have such a strong weighting. What I like in just looking at the 10 industrial names is it's not equal weight, clearly, but they're all similar in the sense that no one name is going to dominate how this XLI trades. And that's important when you're looking at these ETFs to invest in as an ETF itself or as part of a bigger portfolio, to look at the makeup of the top 10 holdings such that you know what names you really need to focus on in order to help sway your conclusion of if you want to buy that name or not. So this is fairly good as compared to some of the other ETFs because, again, it's not equal weight, but the top three names are all 5%. So it's not going to dominate the way some of these other ETFs do. All right, let's take a look at our charts. So we're going to start off with, let's go to the XLI. So here is simply the XLI ETF itself. And I can tell you it looks pretty similar to what the S&P has looked like recently, in the sense that you had the week that made the low. Now, what's different here is that the low here was made in July, a fractional new low as compared to the June 16th low where the S&P bottomed. But you still have the sense that for kind of 5 weeks in a row, you have lows that are all very close to each other. So the S&P had the low down to 36.37 in June, and the subsequent 4 weeks all had virtually a low very close to each other. Here you've got the same type thing, 5 weeks in a row, very close lows, and then the swift move up. So the market absorbed all that selling and then shot to the upside as the shorts were squeezed, and you had the massive rally. And the same way that the S&P got to 43 and a quarter, this XLI got to about 101 and has backed up now to this week's low, which was made just earlier today, is down at 93 and change, and we're still trading at 93 and high change. So from 93 to 93.38 or so, we're now at 93.80-ish. How do we look at this in general? Well, the failure up against what would be a bullish breakout against the bullish propulsion level was disqualified, so you would have never gone for the buy. As well as the fact that you had cloud resistance, as well as the fact that the lagging line topped right against the cloud, the same way it bottomed against the bottom of the cloud, it topped against the top. You almost can anticipate here that this could very well come down in coming weeks to about the 90.5 level, which is where the lagging line would again play with potential cloud support. And that's going to be the important area. So anywhere from there down to, let's call it this dotted TDST line at 89. So 90.5 to 89 is the really important support. If that gives way, then the odds really get up that these lows give way, and then we ultimately sell down to about 77.5 or so. So this is lined up bearishly right now. For near term, you'd have to get back above the highs from a couple of weeks ago to improve the picture. And you may get some interim support here at around 92.60 for the balance of this week, which is the cloud's conversion line. But that's the way this lines up. And again, this becomes in trouble. The more Friday closes we get beneath 88.74, the more that these lows are very susceptible to give way to a much bigger decline. So I'm not saying we're going to do that yet. We'd have to first prove that it's going to break through here. But you kind of get the sense of the key levels here. You need multiple weekly closes now above 99.30, or even we'll call it 99.30 to 100.65 to kind of get a breakout. And I've already defined the downside here near 89-ish, give or take. So that's how industrials look on their own. Let's also look at industrials versus the S&P before we get into the individual names. And so I looked at this chart just a few minutes ago, put up a couple of things here. So here's the downtrend line from the highs back in early 2018. This made the secular high. We then sell all the way down to the secular low in 2020. So this is the COVID low, and you can see how industrials got demolished versus the S&P into the COVID bottom, how they recovered. And now what we've really seen for almost a year now is just we're in a trading channel. So we're close to the top of the channel, and we're close to the downtrend line from the highs. So we're kind of in a pivotal place over the next month or so, maybe 2 months, to see, can industrials break out to the upside, get out of this trading range, and kind of start a whole nother leg higher? Or are we going to fade here and then come back down to the lower end again? And if you're bullish the market, then you're going to think industrials are going to break out to the upside. If you're neutral to bearish the market, then you're going to likely expect them to stall here and potentially pull back in relative terms. So, a decision to make, and this is a big decision I need to make by tomorrow night when I put out the new 7-Eleven report, because I'm going to have to anticipate which way this is going to go now. So that's industrials versus the S&P. Let's get to the individual names. We're going to start with UPS. All right, United Parcel Service. Relatively stronger than XLI. The lagging line broke through the top of the cloud significantly, has actually come back to it now. So you've got some support kind of right where we are now, down to 192 and change. So we're at 195 and change. So the next 1.5% or so, there is some support. If we get at this point, the real breakdown would occur on the more Friday closes you get under 187. the more this is likely to fall down to 175 and test that level. New lows would take us down to 158.5 to 154.5 or so. So that's the way UPS lines up right now. Let's take a look at UNP. Union Pacific Railroad. All right, so we go from essentially kind of a trucker shipper into a railroad, and we've broken beneath the cloud, but the lagging line didn't. So that's kind of neutral. We've now I kind of put this neutral with this needing to hold about 222 or so on the downside. You get a couple of Friday closes on our new 222, then you're likely headed to also potentially test the lows. You've got to get multiple Friday closes above 246 to break this out on the upside to challenge all-time highs. But in relative terms to other charts, this is a decent looking chart. Raytheon, RTX. So this has been above its cloud. We never broke beneath the cloud. So this is even a better relative performer. Sideways for 6 months already since we made the highs. Potentially some support here into the cloud. If this breaks underneath in the next couple of weeks, you break under 89.5, then you probably get down towards 85 or so. Not a huge move, but that's what I'm seeing right now. Certainly the really important support over the next 6 months is between approximately 78 and 80. That's really where this needs to hold, kind of against these old lows. Otherwise, you open the door for a bigger decline. Honeywell. This is one of the weaker charts that we've seen. So multiple 13s against the highs, looking for exhaustion of trend. Since then, price is broken beneath the cloud. The lagging line has broken beneath the cloud. We failed up against the bullish propulsion level. So this looks like it's headed lower too. Right now, I've got 3 different levels that, again, here's an example of getting a support level of 3 different lines coming very close to each other in and around the 187 to 186, maybe even 180, yeah, about 187, 186. So that's the near-term support level. You get a couple of Friday closes underneath there that really would suggest that this is heading down to 169.5 or so to test the lows from this year. This needs to break out above 205-ish, 206 or so to get a better chance for a surge higher that could test and come back to those highs. Caterpillar, CAT. Mediocre name, pretty sideways. You look at this, you go back almost, it's a full year of really being sideways here. So you do have a downside exhaustion signal from a flat market. Doesn't mean as much as if we had actually sold off and gotten that. This is, I'll still say we're kind of in the range. It's a little lower than the average price. And frankly, not a name I'd want to touch because there's nothing here. There's no edge in playing this name right now. Lockheed Martin. The best thing is that this bottomed on a set of 9 count and has bounced since. We still have this week's actually going to be important. If Friday closes above 429 and opens higher next week and takes out this week's high, then you open the door here for a move up to 456.5 or so. So from the current 429. So this Friday's close is actually important if we can get back above 433.37 on Friday's close. Minor support at 419-ish, and then some better support down here, but also not kind of a tough name because there's no real big. I mean, there's some price movement in percentage terms, but when I look at the chart here, it's just not a heck of a lot that I love. It's also a name I probably not really want to be involved in if I didn't need to be. Deere. All right, so now we go kind of the agricultural side of industrials. And even though price broke through its cloud, the lagging line held above. So structurally went kind of neutral to bullish, but didn't turn into bearish mode. The commodity sector in general is doing well, and this has rebounded very nicely from the July lows. Right now, support, let's call it 350 to about 338, resistance 410-ish, and then up at then just really all-time highs. So right now, actually, if I look at where did we close the week that made the highs, that is 403.57 up to about 410 is going to be your resistance over the next couple of weeks, especially if we get a 9 count there. Potential place to lean into. 3M. This took it on the chin recently. Earnings report disappointed. We are on the lowest lows of the year. All right, so this has made new lows this week. Odds are fairly high that this is going to continue falling from the current 124-ish level down to 110 and change. So this is the weakest name for sure that we have seen in the group. And the last is General Electric. Let's take a look at this. So upside exhaustion signal on the same week or 1 week before it made its all-time high has broken through the cloud. Lagging lines broken through the cloud, stalled against its bullish propulsion level in here. Kind of neutral. If this Friday we close beneath 74.38, we kill the up count. It becomes very neutral with a slight downside bias. You will eliminate the bounce effect that we've had. And notice the last 1, 2, 3, almost 4 weeks in a row, this orange colored line, the baseline coming from the cloud model, has capped this stock's ability to rally. So certainly it could pull back a bit here, but not one of the best names we've seen. So that's it for this week. I hope you enjoyed the show. I'll be back next week. I'm Rick Bensignor, and this has been In the Know Trader.